So what we have tried to do, this is the environment, and I wanted to cover these areas because before we look at the real estate and the private equity, we still have more than 65% of our capital, which we believe is correct, in either fixed income investments or in publicly traded markets. So when we do fixed income, our allocation includes Canadian bonds, it includes first mortgages, high yield bonds, global bonds, preferred shares, and second mortgages. And the purpose of that is to diversify, to take advantage of the fact that we get, in our opinion, a better risk-adjusted yield on private debt as opposed to publicly traded bonds, and we can manage the credit risk. So what difference has it made? If we compare if you take that weighted return, if that's the mix of fixed income that you have with us, then in the last 12 months, your net rate of return has been 5.06% net of fees, against a GIC rate that would have been 2%. Over the 3-year and 5-year span, there's at least a 2% a year gap. This is a very important aspect of a platform. If the safest part of your portfolio in this interest environment and inflation environment can at least generate 4 or 5% a year, it makes a lot of the rest of the portfolio building much easier to work with. The other thing that we do on the publicly traded equities, as many of you know, is we are involved in covered writing. So what they do is they reduce the risk that we have in being in long-term equities. They allow increased cash flow because we buy shares of companies we want, we write options on them to generate income. What it does effectively is this. It reduces the chances of upside potential, so we give up some future capital gain to some degree, not a total degree, but it lowers the downside risk. So the thing that's interesting is, let's take a look at how it's done in a combination of bull and bear markets together. So this slide, which is a little hard to see the detail, goes back to December 2007, and it's a comparison between our covered writing fund, the Strategic Income Fund, which is managed by our Chief Investment Officer, Rob Adel, and the TSX Total Return. Now, you can't really read the numbers, so I'm just going to tell you what they are. So in that 6.5-year period of time, one massive bear market in 2008, early 2009, of course, and one incredible bull market since then, more or less, the cumulative return of the covered writing pool that we run, the Strategic Income Fund, is 89% higher than the index has been over the 6.5 years, and it accomplished it with 40% less volatility. And even in the last market correction, the drop in the Strategic Income Fund, because it's using calls, was about 50% of what actually occurred in the publicly traded markets. So it's another way that we decide to manage risk. As long as markets are as volatile as they are and as challenged as they are, we're comfortable this strategy is going to make sense. Where do wealthy people keep their money? This is actually a great report. You would probably enjoy getting it if you just Google Capgemini. You can download this. It's free. They don't charge for it. But it's basically a study of what the world's wealthiest people are investing in. And they basically look at people who have more than $1 million of investable assets. That's 13.5 million families around the world, roughly 400,000, 450,000 in Canada. Where do they put their money? Well, when we look at publicly traded equities, it's only 25% of their portfolio. There's a lot of money allocated to alternatives and real estate to make these portfolios come together. And when we look at other organizations, for instance, Tiger 21, in order to be in this group, you have to have 10 million of investable assets. Their last asset allocation pie showed 44% allocation to private equity and real estate. One of the best run pension plans in the country is the Ontario Teachers' Pension Plan. In fact, it's considered by the economists to be one of the best in the world. And when you look at their asset mix as of a few months ago, 14% to real estate, 16% to private equity, 8% to infrastructure, for a total of 38% of assets under management. And their return since 1990, for the last almost 25 years, has been 10.2% a year. So a very healthy rate of return using that model. CalPERS, which is the largest U.S. pension fund, has reallocated $7 billion from other assets into real estate. This just occurred over the last 2 or 3 months. And Harvard Endowment, which has a very good long-term track record, it manages roughly a $30 billion portfolio for Harvard, is 33% public against 16% private and 25% in real assets. That has given them a 40% overperformance on their benchmark over the last decade. So there's a lot of evidence to support these additional assets. The real assets are a valuable addition to any portfolio.